We tend to think, rather than what sector's going to do, we just think the value style will do well. We're coming to end of cycle. We think globally, so traditionally that's where value does start outperforming. Bond yields are rising. Every sector in Australia seems to have pretty significant headwinds. Banks, as you say, have got the Royal Commission. They've also got a housing unwind. They've got margin pressure. They've got bad and doubtful debts rising. And so a lot of bad news has been priced into banks. I remember seeing CBA at mid-80s. Now it's mid-60s. And so you'd have to say a lot of the bad news from the Royal Commission now is in the price. Resources, of course, have got the China headwind, but there is supply reductions, supply growth, I should say, reductions in the resources space. That's holding commodity prices up. But I think you've got to get an improvement in Chinese growth to get the next leg up in those prices, and I think that's a far-fetched idea. And domestic industrials, of course, are pretty expensive at the moment. So at the moment, I don't see a lot of value in Australia. It's a good yield play. Yield's terrific in a low-returning environment like we're in, but I don't think you're going to get a lot of price growth here. The RBA's not going to cut rates either. We're coming into an election, so fiscal stimulus is probably more than a year away. So to me, Australia's kind of like stuck in the mud at the moment. It's not going to go much up, and it's not going to go much down. I think it's going to just trade sideways and be a pretty boring market, as you say.
Okay. Well, you mentioned, as you have throughout the course of the morning, that we're approaching the end of the cycle when it comes to markets. US markets, you were just telling me, may have already hit the peak. What's then going to be the catalyst then to end the cycle?
Yeah, that's a great question. And the cycle ends every cycle since 1929 the same way. US Fed raises interest rates too much, and it creates stress within the economy given the build-up of leverage. Now, the interesting thing in America, you're not getting the build-up of traditional excesses that you see, which end the cycle. That's housing, that's business investment. People would say, oh, business investment's been strong, but if you take shale out, business investment is still sub-trend. So to me, it will be the US Federal Reserve increasing interest rates in both nominal and real terms, but to me, the stress is actually going to occur probably outside of the US. So I think odds are pretty good this cycle that it will not emanate out of America like every global recession has since 1929. I think it's probably going to emanate out of the emerging markets. It could emanate out of Europe. Italy...
I mean, we've got the Brexit negotiations, which every day we hear, oh, a deal's close, but we still haven't got one yet. Could that be a catalyst, do you think?
No, I don't think Brexit will be, because that's going to be a negative for the UK economy only, and UK's tentacles into other economies, aren't particularly significant to drive economic recession. It could be Italy just coming into funding stresses, blowing out periphery yields and spreads, that then funneling itself through the financial system, causing a contraction in investment. But to me, the way I always think about cycle ending, I look at where's the leverage build-up been the biggest in the previous, coming out of recession. That's been the emerging markets. That's been China. That, to me, is where the stress is going to be.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.